Welcome, grade 12s. You are with Ashraf Patel, Accounting grade 12. Now, you will notice that very often, if you look at your past papers, you're going to find questions on corporate governance, internal controls, and audits. Now, does this appear as a separate question in your question paper? Certainly not. What do you find? You find that within a question, it could be a question on debtors recon, but there may be a question on ethics or internal control or corporate governance. So, understand that this is not a standalone question. Rather, it appears across the question paper in various questions. And very important for you to be able to understand that yes, you must be able to answer these questions, whether it be in manufacturing, companies, etc., etc., etc. Okay, so we're going to start off with some key concepts and things that you must remember. When we're discussing an income statement, remember the new term is now your statement of comprehensive income. So if you see a question that says, draw up the statement of comprehensive income, that's what they're referring to, the income statement. By the same token, your balance sheet is now known as your statement of financial position. You got that? Your balance sheet is known as your statement of financial position. When you are preparing these financial statements, they have to be prepared in accordance with IFRS. What does IFRS stand for? IFRS, the letters IFRS stand for International Financial Reporting Standards. Remember, the world has become very small, and therefore it's important for us to be able to compare with companies overseas because of foreign investment, etc., etc. So now you see the need for our statements to comply with IFRS. Okay. You also get a report which expresses an opinion on the fair presentation of financial statements, and this is known as the audit report. Right? This report, the audit report, is obviously prepared by the external or the independent auditor. Okay? You will see later on, we will discuss the roles played by your different, in terms of your internal auditor and your external auditor. Then you have a report that is issued by the board, which explains important matters relating to the company. Understand that this report is presented by your board of directors, and it is called the director's report. Okay? Now, the question now arises, who prepares the financial statements of the company? Definitely, the financial statements, the published financial statements of a company are the responsibility of your directors. Yes, it's their responsibility to prepare these financial statements. Now, if those audited financial statements, obviously, they are prepared by your directors, they now have to be presented to the independent auditor. Look at the process. And if the independent auditor is satisfied with the financial statements, then he or she will issue an unqualified audit report. What do we mean by this? An unqualified audit report tells you that they are satisfied, the auditors are satisfied with what they see in front of them. Obviously, it is their opinion. They're going to express an opinion, and they're going to express an unqualified, or they're going to prepare what is called an unqualified audit report. Recently, I've also seen the terminology being used, unmodified audit report. Meaning what? The audit report means nothing has been changed, unmodified. Please, grade 12s, do not look at this in terms of the qualifications of a person. No. Look at it in terms of what it means for audit reports. For example, if your independent auditor is not satisfied with certain aspects of the financial statements, then he or she will issue a qualified audit report. Telling you what? It tells you that the qualified audit report says that we as the independent auditors are unhappy with A, B, and C. That means something more needs to be added. We need more information. Something is not hunky-dory here. It needs to be qualified. And the third type of audit report, if the independent auditor is unhappy with the financial statements to the extent where they do not wish to express an opinion, he or she will issue a disclaimer audit report. Now, obviously, you can see the levels of audit reports. Let's go back. The best, obviously, the one every company would love to see, is an unqualified audit report, meaning they're accepting it with no changes. One that needs attention is called a qualified audit report. That means it is fine, but A, B, and C need attention. And thirdly, that your financial statements are in such a pathetic state in terms of relevance, in terms of finding information, in terms of looking at the audit trail, that the auditors would now issue what we call a disclaimer audit report. Means we do not express an opinion. They are so bad, we cannot express an opinion. This disclaimer is also sometimes referred to as a withheld report. In other words, we're not giving you a report because of the poor condition of your financials. When it comes to the board committee, they will make the decisions about directors' fees in the remunerations committee. Remember, it's not just one person deciding. It's a remunerations committee that will sit and discuss these decisions about directors' fees, directors' salaries, directors' emoluments. I'm just giving you different terminology with regards to directors' fees. The board committee, which will assess internal controls and make recommendations on the auditor to be appointed, is the audit committee. They also fulfill a very important role within a company. The meeting where all your shareholders will be invited by the directors to consider the financial statements and to elect directors is what we refer to as the AGM, the Annual General Meeting. Right. We often find that if a shareholder cannot attend this meeting, he or she may appoint a proxy to vote on his or her behalf. So these key concepts are important for you to consider when we're dealing with internal controls, audit reports, and corporate governance. Right. Let's go into our first question. And the first question says, what is the difference in the role of an internal auditor and an independent external auditor? Right, you've got 1 minute to pen down the differences in the roles of these different auditors, with the emphasis being the internal auditor and the independent external auditor. Go for it. Welcome back. Let's see. What do you have? Let's compare. 1, the internal auditor is an employee. Of the company whose job is to monitor internal controls and to conduct ongoing checks to ensure that the risks of loss or theft are minimized. In other words, the internal auditor is there to safeguard the assets of a business, taking into consideration that he or she is an employee of the company. Now, how does it compare with the external auditor or the internal auditor? The internal auditor is appointed by shareholders at the AGM. Remember we said at the annual general meeting, he or she is not an employee of the company. Distinct difference. He or she must maintain independence from directors and other employees. In other words, he or she is not biased towards any of the stakeholders, right? And what must the auditor do? The auditor must express an opinion on the financial statements after having conducted an audit. So clearly, grade 12s, you can clearly see the distinct roles played by the internal auditor, who is an employee of the company and does what? Does the ongoing internal control measures in order to safeguard the assets of a business and also to minimize risks of loss and theft. Your external auditor is appointed by shareholders to do what? To express an opinion on the validity of your financial statements and your external auditor, your independent auditor has to be independent of directors and other employees of the company. Well, guys, you notice, very interesting question. But stay with us because we've got many more interesting questions and we're going to go through these. And hopefully at the end, you would have a clear understanding of audit reports with regards to internal control, etc., etc., etc. See you in a jiffy. Welcome back, grade 12s. Yes, remember I said interesting questions? Another one for you. The question says, explain why the independent auditor must stipulate page numbers. Stipulate page numbers in the audit report. Good? You got a minute? Pen down your ideas and let's see what you come up with. Hi guys, what do you have for me? Let's compare to what I've got and let's see what we got here. Aha, there goes. The readers must be certain what parts of the annual reports have been audited. Okay, now remember, the independent auditor is presenting this audit report to shareholders, right? So me as Mr. Shareholder, I must know exactly what parts of the report have been audited. Also, me as Joe Shareholder will also know that yes, there were other parts, the unaudited parts, might be interesting, but we cannot rely on those parts to make important financial decisions about investments in the shares of the company. Obviously, in terms of the role of the auditors, you cannot expect the independent auditor to check everything from page 1 to page 500. It's impossible. So therefore, they're going to stipulate the page numbers in the audit report. So you as a shareholder will know, right, these parts were audited and these parts were not audited. And therefore, based on the unaudited sections, you can't rely on that to make important investment decisions. Clear? Right. Another interesting question that says here, explain why the independent auditor must mention IFRS and the Companies Act in the audit report. Guys, another minute for you, and as we go along, make notes and then compare and see what are we giving you. Obviously, there are sometimes, and you will notice on the nature of the questions, that these are generally open-ended. So yes, you got to mention these points, but they have to make sense. So go for it. Why must the independent auditor mention IFRS? Remember we discussed IFRS early on, and the Companies Act in the audit report. You got a minute? Okay guys, let's compare our notes and see what you have. Number one, public companies need to comply with IFRS. Okay? They need to comply with IFRS. As many investors move their investments around from one country to another. Remember what we said? In our key concepts, we discussed this. And we said, the world has become very, very small these days. Investors are moving their money as we talk. Money is being invested and moved from one country to another. And therefore, it is important for the companies to comply with IFRS. Number two, the financial statements must be comparable to those prepared by companies in other countries. Yes, you find foreign companies investing in South Africa. You find South Africans investing in foreign companies. So to compare, you got to compare. And obviously, if you have a set standard, namely your international financial reporting standards, it becomes easy to compare across one country to the next country. Now, directors and the auditor have to comply with the law. And which law are we specifically referring to here? In terms of companies, we have the Companies Act in South Africa. And it is the most important law which controls companies in South Africa. Why? Why? Think of this here. Shareholders have invested their money in a company. Okay? So, the capital is provided by the shareholder. Who runs the company? The company is run by your directors. Your directors act as the eyes, the ears, and brain of a company. So clearly you can see there is separation. The company is owned by shareholders, but run by your directors. And in order to control the fiduciary duties of directors, you have the most important act regarding companies or company law is the Companies Act in South Africa. So clearly you can see the Companies Act is there to protect the shareholders. Let's take it to another level. Why would we want to protect the investment of the shareholders? In order to stimulate investment in a country. At the moment, the call out there, if we're looking at it, is for people it's for the company to invest money It's for shareholders to invest money in the economy so that people can get a reassurance of the economy of South Africa, and in that way we can look at economic growth. So keep that in mind. Okay. Interesting question. One that we discussed when we looked at our key concepts. So this one here, we're going to go immediately into a discussion. It says here, explain the difference. The difference between what? A qualified and an unqualified independent auditor's report. Let's see what we have here. One, an unqualified report is one in which the independent auditor does not add in any comment about any aspects that concern him or her, about the reliability of the financial statements. In other words, let's go back to the word that I used. I used the word called unmodified. Remember? It says here, an unqualified report is one which the auditor, the independent auditor, does not change. That means they don't add in anything about any aspects that concern him or her. So in other words, they are satisfied with what they see in front of them. That's what we also refer to as an unmodified. It's not changed in any way. Okay? So an unqualified report, put simply, is a good report. It's one that obviously directors will be happy about because the independent auditor is not changing anything or making any comments on that report. Now, a qualified audit report contains an explanation as to why a specific matter causes concern to the independent auditor. And this will be mentioned in his or her opinion so that readers are forewarned about the problem. Let's illustrate by means of an example. The auditors have found an expense of a director, right, where it was shown as part of the director's fees was shown as general salaries and wages. Now, obviously, this raises a concern. We know for a fact that director's fees or director's remuneration need to be shown apart from salaries and wages. It's not part of your general salaries and wages. That's your normal employees. But your director's fees has to be shown as a separate expense, obviously for transparency. Okay? What do we bring in here now? Remember, we can talk about the King Code, right? And one of the aspects under the King's Code is your transparency, where obviously things need to be transparent and not to benefit any of the stakeholders, so that each one knows exactly what is going on. Okay. We also discussed this one here at length, so we will just go into a discussion on it. Okay? And it says, what is meant by a disclaimer issued by an independent auditor? And very simple, on this one here, what are we saying? We are saying that the auditors were totally dissatisfied with the financial statements. And therefore, they do not comment on the financial statements. In other words, they withhold the report and they say, sorry, but from what we have in front of us, we are unable to express an opinion. And therefore, it is what we call a disclaimer or a withheld report. Okay, so now, in terms of audit reports, we've discussed them extensively, and you should now have a clear understanding. And an appeal to you is look at different audit reports from your past papers and see whether you can identify these as being a qualified report, an unqualified report, or a disclaimer or a withheld report. Guys, take a quick break and we'll be back with many more interesting questions. See you just now. Welcome back, grade 12s. Okay, now you do know that accountants have to belong to professional bodies. Yes, like you get educators belonging to a professional body like SACE, the South African Council for Educators, right? You have doctors belonging to a medical council, and each fraternity would have professional bodies that they belong to. So therefore, the question is, what do the terms SAICA and SAIPA mean, right? At the same time, while you're looking at that question, also look at the next one. How does it help for a business community for accountants to be members of professional bodies? How does it help the business community? It means, obviously, there has to be some reward, there has to be some reason or some benefit behind accountants belonging to these professional bodies. So, look at these two questions in conjunction with one another. Again, write down, because when you write, you remember. So, just to refresh for you, what does the terms SAICA and SAIPA mean? And two, how does it help the business community for accountants to be members of these professional bodies? Go for it. You got a minute to get your ideas together. All right, guys, I'm sure you've got this one correct. Let's see. SAICA, South African Institute of Chartered Accountants. Right? That's the South African Institute of Chartered Accountants. Obviously, a professional body of accountants. And then you have SAIPA, which is your South African Institute of Professional Accountants. Now, obviously, each one of these have their areas of specialization, and definitely, if you want more information, refer to your LTSM, your textbooks, and you would get more information on SAICA and SAIPA. And also, as interesting that many of you are techno-savvy, just Google this and see what are the requirements And just to broaden your knowledge, important guys. Okay, next question was, how does it help your professional bodies to ensure that, remember, one, their members keep up to date with the latest developments. Yes, if there's anything new coming through, whether it be in the form of IFRS, any changes, then if you belong to the professional body, then you are kept up to date with the latest developments. Important one, the members comply with a code of good practice and ethics. Very important. If you, as part of the professional body, if you do something untoward, then there can be complaints against you and you can be investigated. And yes, very important, that if there's any disciplinary action that needs to be taken, it can be taken against errant members, members who do not comply, members who get involved in fraud, etc., unprofessional behavior, unethical behavior. If you, as a member of a professional body, you have to comply with the code of ethics, and if you do not comply with that code of ethics, then definitely you're going to have action, and obviously in the case there will be an investigation, and if you are found guilty, then definitely disciplinary action will be taken against you. Okay. Now, we discussed this, we were talking about it. We said, what actions can professional bodies take if their members do not comply with their standards or requirements? And what are the consequences for members who do not maintain the standards and ethics of professional bodies to which they belong? Let's look at the answer. One, possible actions. There can be an investigation. There can be an investigation of the complaint against you. Two, you may have to face disciplinary hearings. Now remember, we're talking about the auditor here, right? So you are the auditor, you belong to the professional body, and if you do not comply with the ethics and maintain standards, what can happen to you? We said investigation, disciplinary hearing. There could be a possible deregistration as a member of the professional body. That means if you're a deregistered member, you cannot use the term CASA alongside your name, SICA or SIPA, in connection with his or her name, which will then affect your ability to earn income as an accountant or as an auditor. So it shows you how important it is to maintain those standards, to make sure that you have, at all times, you show ethical behavior and you maintain the standards of your professional bodies. Okay, let's look at directors and their responsibilities. Go for it, guys. You got a minute. Remember, we're looking now at the directors and their responsibilities. 1 minute. Okay, guys, let's see what you have. Let's compare it. As a learner, you should realize that directors are in a position of trust. Very, very, very important. They are in a position of trust. In other words, they are using the assets of other people. Remember, we spoke about this earlier on, and what did I say? I said the shareholder is investing money into a company, but that money is being handled and being used by whom? By the director. So the director is using the assets of other people. And therefore, when you find independent directors from outside the business, they will tend to be intolerant of bad practices in the company, as they are not directly involved in the running of the company. Now, these are your independent directors. That means they come from outside of the company. And also, you would find that they could be expected to be more objective than the executive directors. Let's throw a comparison here. You've got your independent directors coming from outside of the company, not directly involved in the running of the company, and within the company, you've got your executive directors. They are the hands, the eyes, and the ears, and the brain of a company. Remember, they are the ones that are conducting the day-to-day business of the company. Okay, let's take another question here. Why do companies get involved in community activities? Right? And obviously, it's the ethical thing to do. It's the correct thing to do. The company benefits in various ways. The company benefits in various ways from the communities that they serve. Obviously, the communities are spending money in the company. So it is just right that the company should put back something into the community. And you also find that the goodwill which will result from this will serve and enhance the sustainability of the companies. Let's do that again. The goodwill which will result will serve to enhance the sustainability, very important word, of the company. In other words, if the company puts back into the community will identify with the company and say, this company, X company, is doing this for us, they're doing this project for us, let's support them. And obviously for the company, we say it will only benefit them in the long run. Right, let's take a look at another question. An interesting question. Your operating profits on sales has decreased from 12% in 2014 to 5% in 2015. Now, once again, look at the diverse nature of this question. Like I told you earlier on, you're not going to get one question that deals with internal control, corporate governance, ethics. No, it's integrated within the question paper in your exams. You've got 1 minute to study this one here, and let's see what answers you come up with. Go for it, guys. Only 1 minute, nothing more than that. Hi guys, grade 12s, let's see what you have. Right, the internal auditor is concerned about what? That your profits on sales have decreased from 12% last year to 5% this year. The internal auditor should do tests to check whether any unauthorized or unusual overhead expenses have been incurred. Right? Do a check. Go back and see, is there something that needs my attention? Something unusual? Or compare the previous year and inspect documents and authorization. Check, were these expenses authorized? Also, is it maybe that your sales have declined significantly? Also, do tests to check that all sales income is accounted for. Maybe some of the sales are not accounted for, and this then results in your sales, in your operating profit being lower. Clearly you can see from 12 to 5% is a significant drop, and definitely something that warrants attention. Okay, grade 12s, what you've seen in today's lesson, we've gone through a variety of questions exposing you to all, these are all possible examination questions which you will find in your past papers. Once again, an appeal to you, use your past papers, work through them, and in so doing, you will prepare yourselves adequately for your exams. Unfortunately, time to say goodbye. From myself, Ashraf, and the crew, James and Abi, make sure that accounting will always be uppermost when you're preparing for your exams. And I have to say this, reach for the stars, and perchance if you don't get there, you're going to land on the moon and be definitely in the galaxy of accounting students. Until next time, be good.